how can you minimize your risk when you're a rental property investor? None of us like, well, I was about to say none of us like risk, but I'm sure there's some adrenaline junkies out there. But for the most part, you want to invest in rental properties for a lot of good reasons, but you're also a little fearful of the risk side. So how can you get a portfolio of rental properties or invest in rental properties in general with the least amount of risk possible? I'm going to give you 3 things that might be able to help. In my opinion, if you go through with these 3 things, I think your chance for success is way higher. And yeah, some freak things can still happen. It's real estate. Who knows? You can't predict everything. But if you follow these 3 things, I would nearly guarantee you, I don't want to say guarantee, but I kind of want to guarantee you that you're going to be in a way safer spot than if you don't follow these 3 things. And I'm going to give you a little mini teaser that the 3rd thing is, number 1, not obvious, and number 2, kind of the most exciting of them all. So you got to stick around. Smash that like button, by the way, if you're stoked to hear these things and if you're interested in decreasing your risk. So what are the 3 things that can make your rental property investing as least risky as possible? Number 1, I think this one is the most important, but I also acknowledge that it may not be the most exciting of them all either. Bear with me. It's education. I know, I can already hear the sighs. I get it. Getting it, the education is not the most fun. When we want to be real estate investors, we want to go flying off into the deep end of the pool, grab a property and just get to it. That's what we're here for. We don't want to sit back and read a million books and, learn all the different things. Like, we want to do it. But I promise you, if you take the time, it won't take that long, but if you take the time before getting into a property to really just get some basic fundamental education to better understand what you're doing and what you're getting into and how to tell a good property from a bad property, you will be decreasing your risk tenfold. I can't tell you how many people come up to me and say, "Hey, I found this property. Do you think it'd be a good investment?" And I'm like, "I don't know. Do you think it would be a good investment?" And at that point, they don't even know what constitutes a good investment or a bad one. And so they have no idea. And I'm like, this is where the education comes in. You want to know those things. So when I wrote my book last year, Not Your How-To Guide to Real Estate Investing, this is a huge part of that book, is getting that education beforehand. And it doesn't have to be boring. It doesn't have to be miserable. When I started reading business and real estate books, I read them like suspense novels. I was so excited. I was like, oh my God, teach me everything. And I wanted to know these things. So the research and education phase should be at least a little bit fun. But in my book, I dive into that is, how do you know? Because let's be honest, we don't know what we don't know in this industry. Most of us didn't learn this in school. How do we even know what we need to learn? So I actually break that down in the book is kind of almost like a little miniature checklist of, if you know these things in bullet points, then you're probably ready to try a first property. And it's not a ton of stuff. It's basic stuff, but how do you know what you need to know? And I share that in the book. So I'll put a link below down to the book where you can read all of that. And even though the book's called Not Your How-To Guide to Real Estate Investing, there's a little bit of a how-to guide in there. Spoiler alert. But the education piece of this is huge. And it doesn't take a lot to make waves of a difference between being super risky with your investments just because you don't know what you're getting into versus having some solid education under your belt. You're not going to know everything before you get into your first property. So don't get stuck in analysis paralysis or whatever. You're going to have to get into a property because this industry is pretty much on the job training. You've got to make mistakes to learn it. But how can we help you not make the big mistakes? Let's try and keep the mistakes, smaller, a little less money out of the wallet. So the education piece, if you take the time to get educated before you dive into properties, 100%, that alone may be the game changer as far as how risky your rental property investing is. Number 2, buy nicer, meaning either the property itself is a little bit nicer, the neighborhood's a little bit nicer. Ultimately, you're driving towards tenant quality. Think about the 2 biggest expenses of a rental property. What are the biggest things that could just tank an investment? The property itself, if it's just in shambles and you end up spending a fortune trying to repair it, and the tenants, if you have bad tenants, they're going to destroy your house and cost you a fortune. So if you can get a little bit higher quality of that, it doesn't mean it has to be the nicest property on the street. It doesn't have to, I mean, you can't always control your tenants, and sometimes people will kind of pull one over on you, but you're decreasing your risk when you get into nicer stuff. So the property, the tenants, this all comes down to neighborhood too. Your higher quality tenants are going to want to live in certain areas, and they're not going to want to live in other areas. When you get into the really cheap properties and the really rundown properties, it's not even, people just think that that's going to be maintenance cost. Well, also think about what kind of tenant you're going to attract, because if you're going to kind of attract the bottom of the totem pole of tenants, you could have some problems coming along the way. It doesn't mean it won't be profitable. It doesn't mean that people don't succeed every day investing in lower quality rental properties, but from the risk perspective, you are going to be increasing your risk when you stay with the cheaper properties in the not as nice neighborhoods, which could potentially attract the lower quality tenants. Nicer neighborhoods hopefully attract nicer tenants, and in neighborhoods and markets that are growing. So again, those growth markets are going to decrease your risk. So buy nicer. That's my point number 2. So number 1, education. Number 2, the nicer you buy, it's not going to guarantee anything, and things can still happen. But again, you're decreasing your risk. If you want a little kind of a sidestep on the risk spectrum as far as what you're buying, I have a video that I'll link to below that talks about the trade-off. It's that spectrum of the cheap properties versus the really nice properties, and where the risk is with both of those, and how to kind of navigate what do you want to buy and where. For this exact reason is the risk mitigation. So again, number 1, education. Number 2, buy a little bit nicer. Now, I told you that number 3 is not quite so obvious, but it's also potentially the most fun. I don't know. I'm a nerd. I like it. So before I tell you number 3, I'm going to ask you to smash that like button again if you haven't already. I'm hoping number 1 and number 2 got you there, and now you're excited for number 3. Hit that like button if you haven't already. And here we go with number 3. This is the most fun one, I think. Buy as many rentals as you can. Come on. That's exciting. Education was boring. We want to buy properties. Well, now we're to the buying the properties part. The more rental properties that you own, the less your risk is going to be. This is the not so obvious part of this, because people would think, wait, more properties, more room for things to go wrong. Possible, yes, but think about it. Let's say you have 10 rental. Well, let's backtrack a second. Let's say you have 1 rental property, and you have some kind of dumpster fire of a situation happen on that property. So now you have an extended vacancy, repairs, whatever's going on, and you only have this 1 property. So guess what? You're making no income from that property during the vacancy. You're having to pull from wherever you get money, if you work or whatever, to repair it. And there's nothing really to offset it. Now, what if you have 10 rental properties and one of those properties has some kind of a dumpster fire, which I guess dumpster fire could be literal in this case, but metaphorical dumpster fire, something atrocious happens. Well, on the 1 property that was pretty detrimental while you just had the 1 property. Well, now if that's only 1 of 10 properties and you have 9 other properties that are functioning and performing, you're making cash flow from those properties. Those properties and their income can, to at least to some degree, offset what you're experiencing with the 1. Now think about if you have 100 properties and you have some kind of big situation happen on one of them. I mean, you'll notice, but like compared to 100 properties, 1 out of 100, not really a big deal, because you have the income and everything else to offset that. So the more properties that you have, the less your risk is, right? Okay. And I get it. There are a couple little things about that. You don't want to buy as many rental properties as you can, not knowing what you're doing and just buying any property, because not all properties make good rental properties. So if you have 10 bad rental properties or 100 bad rental properties, yeah, you're increasing your risk exponentially. But we're going to assume that you did that education piece and the buy nicer piece, and you've got some risk mitigations in with your properties. Now, if you own 10 of them or 100 of them, a problem with one of them is just not going to have as big of an impact. which means less risk to you and less risk to your bottom line. Heyo. And if you don't believe me on that, if you haven't already seen my video about how rental properties make money, they have 5 profit centers. There's a good explanation in there and in my book, if you go back to the book thing, about how rental properties are making money. So even if one of those properties is experiencing something atrocious, it's still making money in other ways, even though a couple of those profit centers might be goobered with whatever's going on. So I hope that was helpful, because I know so many people stay out of rental property investing because it can be intimidating. How do we know? We don't know what we don't know. So I'm hoping those 3 things give you something to focus on in terms of risk mitigation, because as you're getting into investing, or if you already are investing, it should always be in your head of, where are the risk factors? What are the things that I can mitigate as best that I can to decrease the risk? Again, nothing's a guarantee. It's all about decreasing risk. So if this was all helpful, I know you're going to be shocked when I ask you to smash the like button, and also throw a subscribe. If you haven't already subscribed to my YouTube channel, I put a new video out every single week, hopefully with topics that are legitimately going to help you in your real estate investing journey. So with that, cheers to decreasing risk.